Okay. One, two, three. Good afternoon, everybody. Welcome to my YouTube channel again. And I was thinking, we have momentum. My videos are getting some views, especially when I make short videos. We had this stupid video I did with the face of a lady, which got many views, and after that, when I upload something short of 2 minutes, it really gets a lot of views. So I was thinking making a short video with an idea I had today. This is one of the biggest lessons I took from my experience and working in what I work. Ideas are worth a lot of money. Having the right ideas can make you a millionaire, as having the wrong ideas can make you lose a lot. So ideas are very important, if it isn't too obvious to say. And today I was thinking to underline the principle of price action related with how price behaves in stocks that people really like a lot. And this isn't only something that you can find in the stock markets of publicly traded companies and their shares, but you can also find this in normal markets with products. Sometimes products get into ridiculous prices and people are okay paying them, and the product becomes unaffordable or becomes completely stupid to buy it unless you have a special reasons in some cases. So the thing with stocks is that a stock, at the beginning trades up, down, but then perhaps the stock becomes a great success, right? And it starts going on and grows, and it becomes a blue chip stock, which in many cases this happened. So in some point of this history, Wall Street, because Wall Street is simply the community of people that were the most successful in investing. So they hold many of these investments that did great. If they don't hold other type of investments, you also have parts of Wall Street that own private equity, homes, a lot of things. But a part of Wall Street owns these blue chip companies, these successful companies, and they have the guts of not selling here when it was reasonable to sell, and not selling here when the price was going to a PE of 40, and they didn't sell, and the thing went up and went up. So now Wall Street is hedging their bets, meaning that they will continue promoting these stocks as if these were marvelous companies, when in reality are companies that deserve to be ignored. Why? Because the price got too absurd. And you have to understand that this is normal in markets. Sometimes products are successful, so the price gets absurd. At this price point, let's call it P of 80, okay, or even a P of 40 is already completely absurd. Disney has a P of 100, things like that, okay? At this point, there's many stupid people that are buying these businesses at whatever price they feel. So this means the sellers react. They want to hold their shares, they stop selling them at a reasonable price. They stop considering perhaps selling 80% of their position at this price range for a big discount. They don't even want to sell at a reasonable price. They are so happy that they hold a product that stupid people is buying so expensive. The best example is Tesla. How a company can have more market value than all these 5 or 6 or even 8 biggest auto producers, Toyota, Ford, etc. How a small company can have a more market cap than all of those together. It's because of this phenomenon. Okay, and this is, I don't know how to define it, all this area I call it price action. However, prices behave in this way. So a group of stupid people go ahead and start buying at whatever price, and these have consequences. The sellers start behaving in a different way. So what's the message of this? The message of this is that if you want to contact me or a fund manager with my style, that do value investing, but you are wondering if should I buy Apple, should I buy Nvidia, should I buy Tesla, I'm not the right person to talk about that. Because we buy businesses at a reasonable price. We don't buy overvalued. Yes, we can do some voodoo talk that we will do. We can study like many analysts, analyzing if Apple will keep going up, if Apple is going to be 40% up next year or not, how are their earnings, and many other things you can study about these companies. But I'm not the person that does that. So if you're interested in buying these expensive stocks, probably you shouldn't call me, you should call Wall Street and ask them if they have an analyst that focus in spending all his life studying these stupid companies at stupid prices. These aren't stupid companies, but the price is stupid. Or I don't know, they spend all their lives studying all the companies in the SP 500, right? Things like that. You should call Wall Street. And I failed on making this video short already. You can call Wall Street and ask if they have somebody specializing on that area and that knows the future of Amazon, the future of Apple, and is trying to understand if buying Apple at a P of 25 or 18 after it goes down is good investment because it will go up again to a P of 40. You should call Wall Street for that. And the reason why Wall Street have these analysts is because perhaps these analysts work for firms and companies that are holding these companies. So it's in their interest to give salary or some extra income to these guys, which spend all their life doing some voodoo talk about why Apple will go up at 40% because they reported 10% more earnings than expected. Okay? And they do all that voodoo and they get paid for it, of course, because many people hold those investments. Okay? But what I'm trying to say is that value investors and the best fund managers, they don't even look at this. Especially in my case, that we are starting and we can work with smaller companies with higher growth. At the end, it's like two choices. Or you either spend time adding things to your portfolio that have a downside, like this. If Disney stock corrects PE of 100 to a PE of 20, that's the stock going down more than 50%. So every time you feel excited about an idea like that, you're adding one more weakness to your portfolio. You're adding risk. Of course, yes, it's something that can go up. I don't deny that. Okay? But also, you're working against yourself. You are adding to the portfolio weaknesses with downside. So why instead you don't buy the opposite? Why instead you don't look for valuable companies that if they double profits, probably they're going to triple in price, that have enormous upside? Yes, they can have a downside, but it's going to be little because the stock is so undervalued, it's so cheap that it's bouncing up. There's always a limit. Stock prices cannot go to zero if they hold assets, if they hold equity, if they hold earnings and dividends. They never go to zero. There's a floor where stock bounces. So you rather can spend your time adding strengths to your portfolio with enormous upside. And the big question is which way you want to go. You want to go like Wall Street and analyze blue chip stocks, which of course can keep going up, but why you add weaknesses to your portfolio? The people that hold this is people who bought this 30 years ago and they already made bank. And they just want to keep sucking more money out of people by hedging their bets, by continuing convincing people that the price is reasonable and they should keep buying at that price. Okay? But why instead you don't focus in companies that have a low downside? Okay? And even if you could call some of these investments risky, which aren't, if you invest in solid businesses, if this stock fails, but this stock doubles or triples in price, this stock will cover this one, and your portfolio will do okay. As I told you, even if companies go broke, I buy so undervalued that I make more money when the companies go broke. Okay, but that's subject for another day. So the big question is, do I go for this or do I go for this? And for me, the answer is very simple. For Warren Buffett, the answer was very simple. For Benjamin Graham, the professor and inventor of value investing, or the books related with it, the most famous books related with it, the answer was easy. Focus on undervalued assets. Why you want to add weaknesses to your portfolio so you can look like those rich people that bought this 30 years ago when it was at a more reasonable price. Why not instead buying something undervalued? Adding strengths to your portfolio, not weaknesses. Adding upside to your portfolio. Adding equity. Right now, my portfolio, if I have $1 million in my portfolio, actually I have $3 million cash. Or at least $3 million in assets free of debt, because my stocks have so much equity. Okay? I don't buy weaknesses. Okay? The very simple example, and I will finish with this, it's like buying a house. Okay? You can go and buy a house at a nice price, or even do a little bit of private equity. You buy a house that's broken and then you fix it so the value goes up, right? You can go ahead and buy a house at a reasonable price, okay? Or you can go and buy a very expensive house because it was the home of Vladimir Putin when he was a child. So you pay an overprice for it. So then now your trading strategy isn't based in value anymore. It's based on finding a bigger fan of Vladimir Putin or of Brad Pitt, if you bought the house where Brad Pitt lived, a bigger fan, more crazy than you, to go and buy the house more expensive than what you pay. So your trading strategy goes completely bonkers. It becomes different. Instead, if you buy a house at a reasonable price, your trading strategy right now is selling the house more expensive because houses went up in price, or because the neighborhood got better and more expensive and the house produced more dividends. The strategy becomes reasonable, becomes, I won't say predictable, but becomes something reasonable. Instead, you can go and buy the house where Brad Pitt lived, or you can buy the company where Steve Jobs did all the magic he did, and you're gonna pay an overprice for it. So now you're trading in feelings. You're trading that tomorrow someone more crazy about Apple will appear and will pay $300 per share instead of the $200 you pay. Okay? That's the big question. And this is the last message I'm going to give you. That was the subject of the video today. How prices behave. In some point, stocks get very expensive. So those stocks aren't part of the market anymore. They're part of something else. Because it's not a market anymore. It's just a group of stupid people buying it very expensive. Okay? So the price becomes irrelevant because it's overvalued. It has no sense to research about it unless you are an analyst working for a firm that pays you a salary to keep talking about something that doesn't deserve to be talked about. Okay? But yeah, that's basically the video today, and thank you for watching. I hope it was interesting. And I think this is very important, understanding how prices work and why this part of the market makes this part being undervalued. One reason is market inefficiencies, yes, but also a reason for a market being extremely inefficient is because of these players. If these players do great, and I hope they keep doing great, they are going to make the market be even more inefficient than what it will normally be, because of their influence. One part of the influence is human stupidity, but the other part of the influence is human intelligence doing great companies that really, I call them my decoy grenade. It's a decoy. It makes people focus on the wrong side, and then I exploit when I focus on the right side. That's basically the message. Okay, so thank you for watching. I hope you liked it, and yeah, keep watching the video. Leave a like, subscribe, and all of that. And as always, blessings. All the best for you.